Welcome to the Deep Dive. You know how earnings calls can just overload you with data? Well, today we've really gone through Great Southern Bancorp's Q2 2025 results call. We're sort of stepping into that earnings summary role, trying to pull out the absolute must-know insights for you. We're talking, the surprising wins, some strategic thinking, and maybe some challenges they flagged down the road. Our goal here is simple. Give you that quick, clear knowledge download, help you cut through all the noise, stay sharp without getting totally bogged down in every single detail. We've carefully distilled the key points from President and CEO Joe Turner and CFO Rex Copeland. So let's get into it.
Okay, let's kick things off with the headlines from Great Southern's second quarter. Pretty solid numbers, right?
Definitely. They reported net income of $19.8 million.
Which works out to $1.72 per common share.
Right. And that's a noticeable step up. It's better than the $17.0 million or $1.45 per share they did a year ago.
And also up from Q1 of this year, too. That was, $17.2 million or 1.47 TAP share? Exactly. So good momentum. The main drivers they pointed to were higher net interest income and, interestingly, a pretty significant boost from some tax credit partnership income.
Okay, we'll probably need to unpack that tax credit piece later. What about the margin?
Net interest margin, the NIM, also looked good. It hit 3.68%.
And that's up both year over year and sequentially.
Yeah, up 25 basis points compared to last year and 11 basis points just from Q1. Plus, their efficiency ratio improved quite a bit, landing just over 59%.
Wow, sub 60. That's pretty efficient.
It really is. And what stands out is that these aren't just, one-off good numbers. Management talked about a dynamic operating environment, which is usually code for things are tricky. So seeing these results, especially that efficiency ratio, it points to strong core banking fundamentals. Getting under 60%, that really signals they're running a tight ship.
Operational mastery, as you said, gives them an edge.
For sure. It lets them reinvest or, return more capital. So yeah, the growth in income plus that NIM expansion, it really suggests a solid underlying performance this quarter.
Okay, so the headlines look strong. But, the real story is always a bit deeper. Let's peel back the layers. What actually fueled these numbers? And maybe more importantly, how sustainable is it all? Let's start with net interest income. That was up, nearly 9%? What drove that?
Absolutely. Net interest income hit $51.0 million. That 8.9% year-over-year increase. It came from slightly higher interest income, sure, but the real story was the drop in interest expense.
Oh, interesting. So costs came down.
Significantly. Interest expense actually fell by 12% compared to last year, down to $30.0 million.
12%. How?
Mostly because their deposit costs fell. About a 12.3% reduction there. If you look at the average rate they paid on all their interest-bearing liabilities, it dropped from 3.17% in Q2 last year down to 2.75% this quarter.
Okay, so they've been actively managing their funding costs. That's a big lever.
It's been a major tailwind for their margin, definitely. And there was another specific item impacting NIM this quarter, about $434,000 in interest recoveries on non-accrual loans.
Okay, remind us what those are.
Right. So non-accrual loans are ones where the borrower is so far behind, the bank stops counting expected interest as income. These recoveries are basically getting unexpected payments on those troubled loans.
Ah, so like finding money in the couch cushions?
Kind of, yeah. It added about 3 basis points to the NIM. But, management was very clear. You can't predict these. It's a nice bump, but don't bake it into your future forecasts.
Got it. A bonus, but not repeatable. Now, speaking of the future, that terminated interest rate swap sounds like a mixed bag. A boost now, but maybe trouble later.
That's exactly it. And this is really crucial for looking ahead. They expect about a $2 million interest income benefit from that terminated swap in Q3.
Okay, so Q3 gets a lift.
Yes. But, and this is the key thing, the benefit completely stops after Q3. It's gone.
Gone. So a $2 million hole in interest income starting Q4.
Precisely. That's a definite known headwind investors absolutely need to factor in for Q4 and beyond. That income just vanishes.
Okay, that's clear. Any positive offsets on the horizon?
Well, yes. On a more positive note, they recently redeemed $75 million of subordinated notes. These carried a 5.5% fixed to floating rate.
Subordinated notes, like long-term debt.
Exactly. And by paying them off before the rate could float higher, they locked in some significant future interest expense savings. That was a smart move. Proactive balance sheet management.
So that redemption should help cushion the blow a bit in Q3 and going forward.
It should definitely provide a positive impact on interest expense, yes.
Okay, so they're managing the interest side pretty actively. What about non-interest income? That actually went down year over year, right? Dropped about 16.5% to $8.2 million.
It did, but that comparison needs context.
Okay.
Management pointed to what they called unusual items. Remember, in Q2 of last year, they had a big $2.7 million gain from ending a software vendor agreement. That was a one-off.
Okay. So a tough comparison. What about this year?
This quarter, Q2 2025, included about $1.1 million in gains from tax credit partnership investments, which, like those loan recoveries we talked about, are also unpredictable.
So unusual items clouding the picture again. What if we look sequentially from Q1 to Q2? Yeah, good point. Sequentially, non-interest income actually increased by $1.6 million.
Right. And that was driven by those tax credit gains, yes, but also by higher gains from selling mortgage loans and, interestingly, higher debit card fees.
So underlying core stuff like mortgages and card fees showed some positive momentum quarter over quarter.
Exactly. The year over year looks soft because of that unique gain last year, but the sequential trend is more encouraging for the core business lines. And building on that core performance, their expense management was really impressive beyond just interest costs. Non-interest expenses actually decreased.
Decreased, even with inflation and tech spending.
Yep. Down to $35.0 million. That's $1.4 million, or about 3.9% lower than last year.
What drove that decrease?
Two main things. First, a nearly $1 million drop in legal and professional fees. That's mostly because last year's costs related to a core systems conversion didn't repeat.
Okay, that makes sense. And the second?
A $453,000 decrease in expenses related to ORARIO, other real estate owned.
Or IAO, properties the bank took back, right? Usually those cost money.
Typically, yes. But here, they actually generated rental income from some OREO properties. So they turned a potential cost center into a temporary income source. Pretty smart asset management.
That is clever. Were there any areas where expenses went up, though?
Oh, sure. It wasn't all cuts. These savings were partly offset by some increases, mainly in technology investments.
Like what?
Things like core system upgrades, computer licenses, support, hardware costs. That pushed up net occupancy and equipment expense by about $600,000.
So necessary investments for the future.
Exactly. And despite those necessary spends, getting that efficiency ratio down to 59.16%, it just highlights how effective their overall cost control is. They're investing strategically, but still keeping a tight lid on expenses. That sub-60 ratio is really a sign of a well-run operation.
Okay, so operationally, they seem to be executing really well. Let's shift focus now to the balance sheet. How does all this translate into the bank's overall financial strength? Looking at loans first, gross loans actually dipped a bit, down to $4.6 billion, about 3.3% lower than year-end. Management called this strategic balancing.
Right, balancing loan growth with getting the right pricing and structure.
But, in what they called a pretty competitive environment, how much of that decline is truly strategic versus maybe just fewer good deals out there? Are they being too picky?
That's always the question, isn't it? They'd argue they're being disciplined, prioritizing profitable, well-structured deals over just chasing volume, which in this kind of market is probably the prudent approach.
They also mentioned lumpy loan payoffs.
Yeah.
Like that $30 million one right at the end of the quarter. That must make forecasting tricky.
Oh, absolutely. Those large, unpredictable payoffs can swing the net loan growth numbers significantly quarter to quarter. It makes sequential forecasting a real challenge.
Looking at the portfolio mix, what stands out?
Well, the biggest chunks are still multifamily, around $1.6 billion, and commercial real estate at about $1.5 billion. What's also interesting is construction lending. They have about $367 million outstanding, but importantly, another $644 million in unfunded commitments.
Unfunded commitments.
Yeah.
Meaning loans approved, but the money hasn't been drawn yet.
Exactly. It's essentially a built-in pipeline for potential future loan growth as those projects move forward and need the funds. That's a pretty significant number. Now, switching to the other side of the balance sheet funding, total deposits were around $4.68 billion.
How does that compare?
It was actually down slightly from Q1, but still up compared to a year ago.
Cool.
Broker deposits played a role here. They decreased by about $62 million in Q2 itself, but they were up year over year. It shows they're actively using different funding sources as needed.
What about uninsured deposits? Always a focus these days.
Right. They reported about $773 million in uninsured deposits, which they calculated as roughly 15% of total deposits.
15%. Okay, and liquidity?
Seems very strong. They highlighted access to about $1.55 billion in additional funding lines, mainly through the Federal Home Loan Bank and the Fed's discount window.
So plenty of backup liquidity if needed.
Looks like it. A substantial buffer, which provides a lot of flexibility in the current market.
That strong liquidity is definitely reassuring. And wow, the asset quality metrics look stellar.
They really do. Non-performing assets, NPAs, were down to just 0.14% of total assets. That's incredibly low. It decreased by $1.5 million just from Q1.
And they actually had net recoveries.
Yeah, $111,000 in net recoveries for Q2, meaning they collected more on old bad loans than they charged off on new ones. And maybe even more notably, zero provision for credit losses on outstanding loans this quarter.
Zero provision in this environment.
Zero. And they even had a negative provision, a benefit for losses on those unfunded commitments we mentioned, about $110,000.
So credit trends look exceptionally strong right now.
Extremely. And their allowance for credit losses stands at 1.41% of total loans, a very healthy reserve level given the portfolio's performance. And that strength flows through to capital too. Total stockholders' equity increased to $622.4 million.
Which is what percentage of assets?
About 10.6%. Book value per share came in at $54.61.
What drove the equity increase? Mainly net income.
Primarily net income, yeah, plus some stock option exercises. That was offset a bit by the dividends they paid and the share repurchases they did.
Got it.
Their total capital also got a small boost, about $2.8 million from higher market values on their available for sale securities portfolio and those interest rate swaps. And importantly, tangible common equity.
The core capital measure, right?
Exactly, the purest measure. It's sitting at approximately 10.5% of tangible assets, well above all the regulatory requirements. It gives them a really significant cushion.
And they've been putting that capital to work, haven't they, with the debt redemption and the buybacks?
Very actively, redeeming that $75 million in 5.5% sub-debt at par right before the rate could reset higher. That was a really smart, timely move to lock in future interest savings.
And the share buybacks sound aggressive, too.
They bought back nearly 176,000 shares just in Q2. That brings the year-to-date total close to 350,000 shares.
Wow.
And the board just approved a new authorization for another 1 million shares. So they're clearly committed to returning capital this way.
Plus the dividend.
Yep, they kept the cash dividend steady at $0.40 per share, same as Q1. So debt paydown, aggressive buybacks, steady dividend. It signals real confidence in their financial position and future earnings potential.
It certainly paints a picture of confidence. So looking ahead, what did management actually say about the future? Starting with loan growth. They sounded optimistic long-term, but maybe cautious near-term.
But that's a fair summary. Long-term optimism, yes. But they acknowledge the current environment is pretty competitive and there are fewer deals hitting their criteria right now.
Just don't expect a big jump in loan originations soon.
Probably not. They said near-term origination activity likely won't look much different from the first half of the year. And they again flagged the difficulty in predicting those lumpy payoffs.
Right, the lumpiness factor. What about expenses? Are they expecting costs to stay controlled?
Generally, yes. Management guided towards broadly consistent expenses for the rest of the year.
Any potential bumps?
They did mention potential minor increases, maybe from ongoing tech investments, upgrading systems, and possibly some small compensation adjustments like minimum wage impacts filtering through.
And that OREO rental income, will that continue?
They expect it to continue as long as they hold the property, but they did caution it's subject to leases rolling over, so it might not be perfectly smooth. But generally, expect expenses to remain well managed.
Okay, which brings us back to the net interest margin outlook. This seems like the trickiest piece, especially with that swap issue.
It is. Management laid out the puts and takes. On the positive side, you still have fixed-rate loans maturing and potentially repricing higher. And they hope to renew a chunk of maturing time deposits at maybe slightly lower rates.
So some potential tailwinds. How do they frame the near term?
They described the outlook up until Q4 as pretty neutral with a slight tailwind.
Okay, but that feels like it's burying the lead a bit, doesn't it, given what we know about Q4? Yeah, the big takeaway has to be that significant known headwind hitting in Q4 when that interest rate swap benefit completely disappears. That's roughly $2 million in quarterly interest income, just gone.
That's the elephant in the room. For Q4 and IM, absolutely. Management has clearly flagged it.
How much can they realistically offset that with other things?
That's the key question. Their focus, as they reiterated, remains on strong credit, disciplined growth, robust capital, and shareholder value. The message is really about sticking to their fundamentals cost control. Good underwriting to navigate through pressures like this swap expiration. They're betting on operational strength to mitigate the impact.
Okay, we have covered a lot of ground here, really boiling down that Great Southern Q2 earnings call. But before we wrap, just a reminder, a very important one. Everything we discuss here is for informational and entertainment purposes only. It is absolutely not financial advice. Please, always do your own research and due diligence.
Couldn't agree more. Now, with that very clear disclaimer stated, let's have a little fun with our outrageous but plausible trade idea segment. This is based only on the information from this specific earnings call. So here's the idea. Given Great Southern's very strong capital position, that consistent dividend, and especially their really aggressive share repurchase program, one might consider, hypothetically, a long position initiated strategically before the Q4 earnings call.
Okay, outrageous because...
So the outrageous part is this thesis largely ignores or at least significantly downplays that well-telegraphed Q4 net interest margin headwind from the swap expiring. The market knows it's coming and could react negatively.
Right. So why is it plausible?
The plausible angle hinges on everything else they're doing right. Exceptional expense management, fantastic credit quality, actual net recoveries, zero loan loss provisions, and that deep commitment to buybacks, shrinking the share count. Plus, redeeming that $75 million subdebt saves real money going forward.
So the bet is?
The bet is that the market over-discounts the known NI headwind, and that the combined effect of fewer shares outstanding due to buybacks, plus continued cost discipline, maybe they even surprise positively there, could lead to better than expected earnings per share, even if total revenue takes a hit from the swap. And don't forget that big $644 million pipeline of unfunded construction loans. That offers potential for future higher yielding growth, even if overall loan growth is lumpy now. Their capital strength gives them the breathing room to weather short-term NIM pressure.
So you're betting on strong execution and capital allocation potentially overshadowing a known temporary revenue issue?
Essentially, yes. Betting on the underlying quality and management discipline over a specific flagged quarterly headwind, but again, highly speculative.
Absolutely. A fascinating thought experiment, but purely hypothetical. Please remember that. Okay, so let's quickly recap our deep dive on Great Southern Bancorp's Q2 2025 earnings. We saw really strong current performance, good NIM expansion, impressive cost control driving profits.
Right, coupled with very robust asset quality and healthy capital levels, and a clear focus on shareholder returns through dividends and those significant buybacks.
But there are clear challenges ahead. Chief among them is that interest rate swap expiration, creating a known headwind for net interest income starting in Q4.
Definitely. So as you think about this, maybe consider how these insights, the operational efficiency, the capital management, the strategic priorities, might inform how you view regional banks navigating this dynamic environment. It kind of prompts you to think about how strong fundamentals and proactive management can, or perhaps can't, fully offset market headwinds. What really makes a bank resilient?
Good points to ponder. Remember, this was our deep dive into the source material from Great Southern Bancorp's earnings call. And that trade idea, purely information, definitely not financial advice. Thank you for joining us on the deep dive. We hope this helps you stay informed, and we look forward to exploring more complex topics with you next time.